Good evening, everyone. Welcome to the webinar, and thank you for taking the time out of your evening to join in and listen to us share what we believe is one of the greatest opportunities available in real estate today. My name is Spencer Riche. I am co-founder and director of R2 Capital Partners. I am one of the two general managing partners of the following investment. My background is in industrial construction, specifically pipe fitting and oil and gas. And over the last 7 years, I've been actively involved as a manager in various real estate investments. My primary roles with R2 Capital are acquisitions and project management, everything from deal sourcing, value add implementation, and ongoing management post-stabilization. Brock Rogerson is the second managing partner in this investment. Brock is also co-founder and director of R2 Capital. Brock has an extensive background in banking. He worked 16 years in CIBC's private wealth management, where he consulted for wealthy individuals and corporations in Western Canada. Brock is a notable real estate investor, having won various awards and investment achievements. Brock's key role in this investment is overseeing financial structuring, investment overview, and investor relations. R2 Capital Partners is a tech-enabled real estate investment firm offering investors diversified exposure to residential and commercial real estate, utilizing a vast network of partnerships, relationships, and industry-leading technology to capitalize on emerging markets in secondary and tertiary markets across North America. We currently have $45 million in assets under management. Today, we are here to discuss the opportunity of the R2 SFH fund. R2 SFH fund can be summed up into one sentence. We are building a cash flow focused, geographically diversified portfolio of U.S. residential real estate, enhancing returns through technology and realizing a multiple expansion on exit. For the remainder of the presentation, I'll be working through each line of this sentence, followed by our track record of active examples, investment structure, projected returns, and finishing off with some questions. Cash flow focused. What makes our strategy different than traditional real estate investments is that we are not speculating on real estate values. We handpick each property based on the income stream that it has potential to generate. Of course, we underwrite each property to ensure it's positioned for the highest potential of appreciation, but our model is not reliant on it. To us, that is just icing on the cake. Our main driver of returns is cash flow. Traditionally, real estate is a low cash flowing asset. Through our scrutinous acquisition process, management strategies, and technology stack, we are able to deliver the highest cash-on-cash returns we've seen out of all real estate asset classes while substantially mitigating our risk. Our strategy is designed to perform in all stages of the market cycle, regardless if property values go up or down, we still make money. We do not buy with the hopes of an Amazon building or fulfillment center coming next door, a new LNG port opening up. We buy based on the income that each property can generate today. The two houses you see on the screen are the first two acquisitions we made in the US back in 2020. Highlighted on the bottom is the cash-on-cash return of the two operating scenarios, long-term rental and short-term rental. And as you can see, the return generated from the STR significantly outperforms. Keep in mind that cash-on-cash return does not include forced value through improvements, principal payments, or appreciation. For example, we purchased both of these homes for $700,000. Their current value is $1,046,000, which is not factored in on the cash-on-cash return. The annualized internal rate of return of these houses are well north of 40%. Geographically diversified. We believe in hedging our risk through diversifying our acquisitions geographically. Let's use an example of purchasing a 100-unit apartment building. This is a large singular bet on one location, one neighborhood, one local government, one set of operational crews, one demographic of tenants, etc. We believe it is less risky to own 100 homes across 10 different markets instead of placing our bets all on one location. Furthermore, news headlines lead people to believe that real estate countrywide is moving in the same direction, downward. That is simply not true. Real estate is hyper-local to its independent market, and its values rely heavily on specific factors within its own market. This is because the media has a tendency to focus on the major markets where larger shares of people are affected, like the LAs, the San Franciscos, New York, Seattles, etc. They do not focus on the cities in middle America, the unsexy markets where there's no big news, no massive swings in domestic migration, No dramatic ups and downs in property values, just boring, slow-moving, and predictable markets where there is no reason for attention in the first place. This is where we invest. Not only because we have little to no competition from an acquisition standpoint or operationally, but because the chances of a dramatic correction in values are much lower than in a primary, faster-moving, exciting cities. Thus, our strategy is to build a portfolio in not just one of these markets, but hedge our bets by diversifying across the best value markets throughout the entire U.S. Why U.S. residential real estate? Supply. The U.S. is short 5,240,000 homes and growing. This is a result of a decade of underbuilding since the GFC, the Great Financial Crisis. There is a 60-year low for new single-family construction permit issuance. There is less than 2 months supply of existing homes for sale. The hoarding of low-rate mortgages, so homeowners are less likely to sell and give up their 30-year fixed-rate mortgage at sub 2%, so either they stay put or turn their property into a rental. U.S. property tax structure also favors long-term ownership. An example of this is in the state of California, their Proposition 13. Demand. The largest generation of potential buyers is waiting to become homeowners. Work from home trends are fueling deurbanization, demand for larger homes in warmer climates. Single-family homes are the most debt-friendly and most liquid real estate asset class. If you had to sell a single-family home versus a 150,000 square foot commercial retail plaza, the single-family home would be a lot easier of a sale process. Immigration, both legal and illegal, continues to increase demand for housing nationwide. Valuation. The average U.S. home price is less than half of that of a Canadian home. Household income required to cover ownership costs in Canada is 47, getting close to 50%, whereas in the Southeast U.S. specifically, home ownership costs are below 28% of household income. Canada's weakening economic performance, debt levels, and stagnant dollar relative to oil prices make U.S. assets an attractive hedge, and housing historically is an inflationary-friendly asset class. From an institutional view, institutional investors still comprise less than 2% of the single-family market, whereas institutions own 55% of the multifamily market in the U.S. Single-family homes remain very fragmented and ripe for consolidation, similar to multifamily REITs in the 1990s. Capitalization rates are 10 to 15%, materially higher than the borrowing costs of 5 to 8%. Over $48 billion was invested into single-family homes by institutional investors in 2021. Enhancing returns through technology. Through recent developments in real estate technology, we are able to scale single-family home investments across the country while remaining vertically integrated, generating more profit, and having greater protection over our assets. Technology allows us to go direct to customers and offer short-term rental, mid-term rental, and long-term rental accommodations with 5-star services and amenities. As discussed earlier, this is what enables us to deliver such a strong cash-on-cash return. On average, short-term rentals generate 3 times more revenue than a traditional long-term rental, and furnished rentals, so this is a long-term rental that comes furnished on a long-term lease, will generate 50% more revenue than a traditional rental. And both offer significantly more control and protection over the asset. We currently host over 5,000 reservations per year. Not once have we had damage over $2,000. And in the event that we do, we have client credit cards on files and a charge would be made to reimburse the cost of such damages. Or we can recoup any damages from the OTAs, the online travel agencies, directly through their insurance services. From our firsthand experience, a traditional long-term tenant can cause upwards of $40,000 in damages, leave the keys, and you're stuck with the bill. Through our ID verification, machine learning software, we know exactly who is in our property at all times. We ensure full and complete payment via ID and credit card matching software. Payment is made upfront with an authorized hold for damages and incidentals. During our booking verification process, each guest is automatically run through a comprehensive screening check. We cross-reference their online identity, verified social media accounts, their home address. We use their phone's IP address to view the proximity to the rental at the time of booking, validating if the phone number is real or a burner, prepaid burner, searching for felonies or criminal history, soft credit checks, and much more. These factors are all used to determine if the guest is really who they say they are, and the software then decides if the booking request will be accepted or rejected. Each of our properties is equipped with digital locks that generate one-time codes, permitting guests access only during the reservation, as well as monitoring foot traffic in and out of the home. Each house is equipped with a decibel level monitor system. Once the decibel levels exceed a certain threshold, guests are given 3 warnings to reduce the noise to an acceptable level. After the 3rd warning, local security teams in cooperation with local authorities are dispatched to remove guests violating our terms of service. Not only does this protect our assets, but it also keeps the relationships with our neighbors and community strong. Additionally, each house is equipped with a Wi-Fi tracking software, which gives us direct insight into how many devices are connected in the home, as well as live feeds to exterior 2-way audio security cameras. Further, each house is equipped with smart learning thermostats and infrared sensors that detect when guests have stepped out or checked out and automatically adjust interior climates to reduce our energy consumption. We utilize dynamic pricing software similar to the airlines, which adjusts our daily rates based on local STR and hotel occupancy rates. Our software will identify when competitor rooms are booked and increase our rates based on our set parameters. Our housekeeping standards are kept in check via photo verification on each turnover. So in order for our housekeeping staff to get paid, they must follow our provided checklist and upload photo and video confirmation for each item. Once confirmed by our team, payment is released. After booking confirmation, guests are given various upsell requests where they can choose to pay fees for the following services, such as early check-ins, late checkouts, pet fees, damage waivers, trip insurance, and various packages where the house comes stocked with Gatorade, snacks, wine, or any other personalized requests. Our properties are live on 13 different online travel agencies. This includes, but is not limited to, Expedia, Booking.com, VRBO, Airbnb, Google Hotels, TripAdvisor, Travel Station, Hopper, and a recent partnership with Marriott Homes and Villas. Additionally, we offer direct bookings on our website, which accounts for 10% of our reservations. We currently invest $0 into advertising. Lastly, we have our own dedicated call center where we provide guests with 24/7 direct communication via phone, text, or email. Realizing a multiple expansion. When it comes time to exit the investment, we intend to realize a multiple expansion on the sale. This is just a fancy way of saying that our goal is to sell the portfolio for a premium based on the income that it generates. Here's how. When we are acquiring these assets in the 10 to 15% cap range, which in today's market is exceptional, the average cap rate within all real estate classes lands somewhere between 6 and 7%. We know institutional investors such as Tricon and Blackstone are buying single-family rentals as 5 caps. For those unfamiliar with the terminology, I'll give a quick explanation. A cap rate is short for capitalization rate. It's simply the multiple an investor is willing to pay for that income stream. The formula is net operating income, or NOI, divided by the market's cap rate. This will give you the value of the asset. The higher the cap rate, the smaller the multiple of net earnings. Therefore, the lower the cap rate, the greater the multiple of net earnings. For example, let's assume an asset is valued at as a 10% cap rate, which means that for every dollar net income that asset produces equals $10 in value. So it's 10 times multiple. You take the $1, divide it by 0.1, which is 10%, gives you 10, equals 10. If the cap rate is 6%, for every dollar net income would equal $16 in asset value. Thus, the multiple of earnings is 16.66 times. So you take $1 divided by 0.06, gives you 16.66. Therefore, if we can acquire these assets at a 12% cap rate and sell them as a package closer to the real estate trading range of, say, an 8 cap, that means that for every dollar net income that we generate, we pick up an additional 4 times more in portfolio value. Thus, if the net income of our stabilized STR portfolio was $1.5 million, when valued as a 12 cap, would make the portfolio worth $12 million. If the NOI is valued as an 8 cap, the total portfolio value would equal $18,750,000. In this scenario, we'd pick up $6,750,000 in premium by increasing the multiple on sale. Now, the natural question would be, why would someone pay a premium? Well, just like any other asset class, once you have a consolidated and stabilized portfolio, there is value in that turnkey income stream. Additionally, the larger the amount of capital that can be deployed at once often commands a premium for the ability for investors and money managers to place such sizable amounts of capital in one transaction. Say an investor wanted to increase their exposure by $30 million to a certain asset class in real estate. Well, you can go to the market, you can find that in the multifamily space, office, residential retail, self-storage, mobile home park, etc. Want to know one asset class that you can't? That's short-term rentals. It's too new of an asset class, and it's too time intensive for large firms to build out the systems, run around buying houses one at a time, setting them up and stabilizing them. That is where we come in. We will happily do the grunt work. Consolidate a niche class of real estate, stabilize it, wrap it in a bow, and sell it as a turnkey income stream to an investor looking to get a large diversified exposure by writing one check. We've already seen this countless examples over countless times over the last few years of investors purchasing residential properties based on the short-term rental income. Here are a few examples back in 2020 when we first started buying in Atlanta, Georgia. Residential properties are being converted to short-term rentals, and after a year or two of operating, selling for more than twice their value because of the income stream they generate. We want to do this at scale and hedge investors' risk by geographically diversifying and not putting all of our eggs in one basket by betting on one city. And if we do not realize a premium on the sale, whether that be through selling as a portfolio or selling off groups of properties fractionally, we will sell the homes traditionally, one by one, which is what our financial model is based on. We have not included in the premium, any of this premium, in the eventual exit of our fund. We are only highlighting this as a large opportunity that we see and can hopefully benefit from. Moving on to our track record. So the following are examples of properties that we've acquired and are operating. This is 301 Pendle. As you can see, especially for my Canadian viewers, you can still purchase a 3-bedroom plus home on a 1-acre lot, turnkey, for under $200,000. These are examples of the purchase price of the home, the market value. This is the arbitrage in how we're able to identify and purchase at 5 to 10% discount, and I'll discuss that later. Here's the invested capital into this deal. The net operating income, obviously subtract your debt payments, gives you your cash flow. Here's the cap rate on purchase, so 15.7, which is exceptional. Cash on cash return is 28% for the first year. Internal rate of return is 32%. So that's where we include the debt payments, appreciation, forced value, cash flow, everything. It's the all-inclusive return. And then our anticipated sale price in year 7, assuming selling as one by one, none of that premium, which I discussed in the last part. This is the next home. This is a 5-bedroom home on a full acre of property, which we purchased for $215,000. If you believe in the Zillow's estimate, this property is actually currently assumed to be worth $300,000, which would be excellent because we just purchased this a year and a half ago. We've done nothing significant. We've done light fixtures, maybe some paint and some cosmetics, but really it was just an exceptional purchase that we were able to identify and turn into a great cash flowing rental property. Here's a few more. This is a 3-bedroom house in Indiana. This is a 5-bedroom duplex actually in Georgia. Again, you can see the insides of these properties. These are beautiful. A traditional long-term rental does not look like this on the inside, and you cannot maintain it to this type of quality and standard. These two houses are in Alabama. The house on the left is a 4-bedroom home. House on the right is a 3-bedroom. Again, great returns, great entry prices. These houses are also in Alabama. The house on the left is a 3-bedroom house. The house on the right is a 4-bedroom house. As you can see, we like to go a bit above and beyond with our amenities. We convert rooms into game rooms, offering foosball tables and different types of basketball and games and multiple TVs and cable. We add additional beds in the rooms because more heads in beds, you can get more people. It lowers the cost for them, and it's a better experience for the guest. There's ways that we can significantly increase the revenue in these properties that when we're operating in these smaller value markets that we have no competition from an operational standpoint. So utilizing these strategies really helps us stand out and maximize revenue. The next house is in Virginia. This one's also in Alabama. 5-bedroom house, a block from the beach. This is more inner city, more of a budget traveler style. Again, still beautiful on the inside and much more competitive than a hotel for its cost. These next two houses are in Alabama as well. The one on the left, 3-bedroom house. The one on the right is a 3-bedroom house with an auxiliary dwelling unit in the rear. So we also have another 1-bedroom back there. These are actually great buys. The projections, we just purchased this one literally last week, so we haven't had time to fully run it and verify and get true numbers on this. So the numbers seem low because they're just our conservative projection. But the duplexes do exceptional because you get the opportunity to not only have one listing from the main house and a second listing from the rear unit, but you can also do a grouped listing. So that's where you take both listings and you list them together, creating a third and appealing to different types of travelers, different group sizes, etc. So they're actually probably the best bang for your buck. Acquisition, process, and criteria. We have a 41-point buying criteria when it comes to identifying and underwriting each property. I listed a few of those in the metrics here below. We look for a minimum of 3-bedroom plus homes positioned on large lots, ideally 4+ bedrooms on corner lots with no rear neighbors. We look for houses that require light cosmetic upgrades such as flooring, paint, fixtures, and amenities. Pro-landlord and pro-business states, ideally with favorable STR regulations. Our target GRM, or gross rent multiple, for STRs is 5 or less and 11 or less for LTRs. The average household income in the target zip code must exceed $45,000 and be growing. The market must have a diverse employment sector, four major key industries. We do not want to be reliant on one such as tech or oil. Net immigration rate exceeding the national average. So we want to know that the city is growing and that there is demand there. Year-round travel increasing and increasing demand for short-term rentals. So we want to make sure that there is still demand for the product that we are offering. Each house must have something unique about it, no cookie cutter layouts. And we believe that people book STRs for two reasons. The first reason is that people want to save on cost. They want to group together and have a family rent out a 4-bedroom house instead of 4 different hotel rooms and not having that communal place where they can come together, have a good experience on their travel, cook meals, and that sort of thing. For a much cheaper cost than obviously doing the hotel route. The second reason people book STRs, in our opinion, is that people book it for the experience. They want to pick out a nice home similar to when you're shopping for a house to rent or to live in on Zillow or Redfin, etc. You're looking for these beautiful homes, and it's the idea of that experience that I think gets people excited. So we want to be able to deliver that. So when they're looking through the listings and trying to decide between us and our competition who to pick, we want to be that house that stands out, that unique home that's not average, that gives people that unique and desired experience. So the two reasons people book, one is to save on costs, and the second is the experience. And that's why we also provide the amenities, and we go above and beyond with technology and all the other services and amenities that we provide. Even though a 41-point buying criteria seems like a lot, this still casts a large net when you factor in every single real estate market across the entire United States, which is why we've developed software to ramp up the speed of our search process. This software plugs directly into the MLS and searches every single house that is currently for sale and has been sold each day across the entire United States based on our 41-point buying criteria. The software can underwrite 1,000 addresses every minute, providing accurate projections of income potential and cash flow. The software then ranks the highest yielding opportunities and notifies us of that list. From there, we perform our final underwriting step. We review each property to make sure it is a correct fit and look for anything that the software may have missed. As great as it would be for technology to do the legwork for us, it still requires a human eye and judgment. There are many cases where a property looks like a great fit until you see the quality of the interior, any deferred maintenance, the economics of the neighborhood, or abnormalities in comps used to project the income. The real benefit that software provides is creating a massive funnel to identify trends in zip codes and markets that routinely pop up as great buys. This helps us quickly identify changes and trends in the overall market and locate the best deals available. Once identified, we then proceed with an offer and start negotiations. Based on this detailed acquisition process and strategic negotiations, we are able to acquire properties at a discount of up to 10% of their market value. Plan A, B, C, D. I should have picked a better name for this slide. At the end of the day, the underlying asset is residential real estate. It will always have value. It will never go to zero like a business or a stock. The key is how we position each property to its highest and best use to maximize cash flow, but also mitigate our downside, which is why you need multiple plans in case plan A fails. Each plan in this list is listed from the highest potential use from a cash flow perspective to the lowest. Plan A is short-term rentals, STRs. The definition of an STR is renting out a property for 30 days or less. We have yet to find a strategy that performs better than operating as an STR, than a property operating as an STR. However, in the event we can no longer operate each house as an STR, either the margins shrink, local regulation, or other factors, we want to make sure we have several backup plans. So plan B is a midterm rental. Since each house is already outfitted from a furnishing standpoint, it is simple to transition to list each house on a 30-day minimum. The majority of these tenants are traveling nurses, victims of home insurance claims, traveling tradesmen, etc. Plan C is rent by the room. Adding to the previous plan, for us to install digital locks on each room and rent out each house by the room is a simple transition. Various platforms such as Pad Split is an example of where we would advertise our homes. Plan D, long-term furnished rental. We would sign longer-term leases with tenants to rent the house out as is, but at a 50% premium for the benefit of having a fully furnished and fully stocked house. Plan E, student rentals. We would tailor our advertising to the student demographic where the leases are backed by strong co-signers, the student's parents. And then Plan F, the ultimate fallback is listing the house as a traditional long-term rental. Each house is underwritten with the ability to cash flow in this scenario. Obviously, the cash flow is not as great as a short-term rental, but it still cash flows. We will not proceed with a deal if we do not believe that we can maintain an 11 times GRM or the 0.9% rule as a long-term rental. Investment structure. So the total investment size or the total raise of this fund, which is small compared to most funds, but that's because we're placing 100,000 at a time. Well, if you factor in leverage on some of these houses, we're buying $200,000 houses, and with leverage, you're factoring probably 60 to 70% or 60 to 70,000 down initially. So for $5 million leveraged, it's a lot of work to do. So for us, 5 million is all we really believe that we could handle at this point. We didn't want to take on more because we believe that we would end up sacrificing returns because we wouldn't be able to place the money as efficiently. So anyways, the fund size is 5 million. From the management, from us, we're putting in $1 million. The investors are putting in 4 million of that 5. The investor return is targeted at 24.1% or a 3.1 equity multiple. I'll explain more of that on the next page, as it's actually kind of hard to fully pinpoint the projected return, because when it comes to the way that we underwrite properties, we actually want investors to get their capital back as quickly as possible. That is our main priority. So the rate of the return of capital is typically within 2 years, but to give ourselves some breathing room with this model, we gave it 3 years. I'll actually just jump ahead to kind of illustrate what I'm saying. So in the first 3 years, we ramp up, and the idea is that through purchasing these properties correctly, getting them operating, and acquiring favorable financing after a couple of years, our goal is to return the investor's capital within 3 years. Obviously, you still have equity left in the investment. That equity is then what generates the 24% return over the additional remainder period of the investment. So the plan is to get your capital back in 3 years, and then the equity that is left in earns a 24% annualized return over the remaining course of the investment. The investment strategy, which we've been talking about, the anticipated leverage is anywhere from 75 to 80%. Leverage is not to exceed 80% loan to value. The minimum investment is $250,000 US. That can be from an individual or pooled together in an entity. The investment term is 7 years with an option to extend by 1. So something to keep in mind when you are investing in private equity. It is an illiquid investment. So even though our plan is to try to return the capital to you and obviously hope to have distributions along the way, you should view this as a long-term investment and that the funds could be tied up for a total period of 7 years with an option to extend by 1. The option to extend by 1 gives us flexibility based on where we are in the market cycle. We obviously do not want to be selling the homes for a loss, so we'll hold on to them, keep the cash flow, and wait until we, as managers, believe is the correct time to exit. The distributions come in the form of a waterfall, so there's a preferred return. So the first 8% of all profit goes to the investor. Above 8%, there's a profit share from 8% to 20% of the total return. From that, in that range, 80% of it, again, goes to the investor, and then 20% goes to R2, which is us, the management. And then if we manage to exceed the 20% return, the profit share flips, and the investor gets 30% of that, and R2 gets 70%. The fees, we tried to make very competitive to the industry, so our fees are actually quite low. The management fee of 1.5% on 5 million is 75,000. So divided between me and my partner Brock is 35,000 a year. We are not getting rich off the fees. It is basically to help cover our overhead and our costs while we proceed with this investment. Strong investor returns. So as we discussed in the previous slide, the idea is to return the investor's capital within 3 years. And then after that, it's a 24% return cumulative until the end, which is when we really would realize that big payout on the eventual sale or the eventual exit. On the other side is just a comparison between the other real estate firms. We needed to make it attractive by lowering our fees, but also by offering a superior product and hopefully achieving a higher return. Us being a smaller, nimble firm allows us to execute on this. And as I discussed before, the larger amount of money, it's typically harder to get greater returns because you have to be much more selective and you're limited to the different types of opportunities that you have. These are the levered forecast sensitivities that we've done. So in the event that our GRM is a plus or minus, this is the difference in returns that it would add. Same thing with vacancy rates or our occupancy rates. If interest rates go plus or minus 2%, this is what it does to the total return, and cap rate. So depending on the way that we can exit the property, that will decide on the differences in returns that an investor can expect. Structure and org chart. This is the structure of the fund and how it is. We have on the Canadian side, there's a limited partnership. This is which the investors and us, the management, invest into. From there, it invests into it's actually missing on the slide, is a Canadian corporation, which is what files the U.S. tax return. So that way our investors are not susceptible to filing U.S. tax returns and exposed to the various other disadvantages that come to having exposure to the U.S. tax code. And from there, that Canadian corporation will invest into a U.S. C Corp. The U.S. C Corp then is what owns and buys all the properties underneath. And that concludes the webinar for today. We will jump now into the question section. I see that there's actually been a fair amount of questions that have piled up here, so feel free to continue to enter them in, and I will start going down the list here. First one is from Jason. You mentioned other real estate firms are buying single-family rentals for 5% cap rates. Can you please elaborate on the source? Yes. On Tricon's March 2023 earnings call, they told shareholders that due to the increase in interest rates, their cap rate to borrowing costs spreads had shrunk so significantly that they are now buying assets with cap rates below their cost of debt. So I actually, if you go back, when I sent out the review or the replay of this webinar, I've actually included a screenshot from that earnings call that I had referenced. So feel free to go and check that out. It's actually very interesting because they're in a similar space, but obviously not managing the properties in the type of way that we are through the STR or acquiring them in the same fashion. Janice, how are STRs viewed from a lending perspective? Excellent question. So the lending market is catching on to the trend quickly in the fear of missing the opportunity. There are now various lenders throughout the U.S. who will lend commercial mortgages on non-owner occupied residential homes based on the short-term rental income projections. These are the lenders who we've currently been working with. When we started, our interest rates were 5.8%, but given everything happening economically over the last 6 months, our current borrowing costs have increased to 8.75% for 30-year fixed debt. Once we build a large enough portfolio and stabilize it by hopefully year 3, at the same time when we plan to return hopefully all of the investors' capital, we plan to roll the portfolio into a cross-collateralized portfolio loan to get better terms and reduce our borrowing costs. Darren, how many homes do you currently have in the U.S. and what is the projected revenue of those homes? We currently have 17 homes in operations as STRs in the U.S. Our annualized projection revenue for those 17 properties is just shy of $4 million. It's $3,965,000. Our combined acquisition cost of the current portfolio is about $4.1 million. It is currently valued at $4,755,000. That's adding $623,000 in appreciation by getting favorable entry prices, which delivers an excellent return on a leverage basis. So our down payment for that portfolio is about $1.24 million. So on $1.24 million, $623,000 gain exceeds a 50% return just on equity. So again, we're not buying with the intention for appreciation, but we are buying to ensure that we are positioned for it. Jackson, how do you project the STR revenue? Good question. If we are not already active in a market, we use a combination of various sources, those being AirDNA, Price Labs, Rabu, and All the Rooms. AirDNA is the primary data source that we have the most confidence in and is really the leading provider of STR data in the industry. Many lenders and industry leaders rely on their data. AirDNA maps over 10 million STRs globally, recording each of their daily rates and occupancy rates. We use this data to build our own comp sets, which we then use to cross-compare against targeted properties. Let's see here. Claire, aside from the financial due diligence, what measures do you take when reviewing a purchase? When it comes to the physical due diligence of each asset, we hire the most comprehensive inspection available in that market. This includes a 60-plus page report of all the mechanical and structural and cosmetic aspects of each house. We also scope the sewer lines. We order 360-degree virtual walkthroughs. We have floor plans of the house drawn up. We get mold tests done, water tests done, rodent tests done. We do infrared scans. And lastly, we verify the value of the asset by ordering a third-party appraisal. This process is standardized on every acquisition to ensure we know exactly what we are buying with no surprises. If the inspection brings back anything significant, we either get it back in the price negotiations or we just move on to the next opportunity. Anna, will you buy in Canada? No, in this fund, we are only purchasing assets in the U.S. Maybe in the future, we will open a similar investment vehicle to repeat this strategy in Canada. However, that is very unlikely given the current cost of housing, the political landscape, and the revenue potential. The U.S. greatly outperforms. Omar, can I invest through my corporation? Yes, absolutely. The investment can be from a Canadian individual or a Canadian entity. Those who are not Canadians can invest by forming a Canadian company, which then invests in the limited partnership. If you're not a Canadian already and you're planning to invest, I would highly recommend consulting an expert in cross-border taxes and legal and everything from that standpoint. Jesse, how do regulations affect the STR model? Great question. So we are very diligent when it comes to underwriting each asset and ensuring we are on side from a regulatory standpoint. We will never proceed with a property knowing it would be considered operating illegally. We aim to invest in markets that have defined regulation, as we believe that helps our revenues due to the regulation creating barriers of entry. Most mom and pops will not be willing to shell out additional funds for licensing, permits, home inspections, and additional taxes. We are constantly up to date on the ever-evolving regulatory environment of STRs or Airbnbs. We've mapped nearly every city in the US, recording their stance on regulation and continuing to monitor it over time. Interestingly, unlike in Canada, we've seen a theme in the markets located in the Southeast US. They tend to grandfather existing operators when they implement regulation. So for example, this happened in Nashville where they capped STRs in the city and grandfathered existing operators into that cap. We've seen some of those property values triple because of their ability to operate as an STR. Think of it as like the taxi medallions. So the silver lining in regulations is that there can be a great opportunity. Next one is from Dylan. How have you been affected by the Airbnb bust? The short answer is no, we have not been affected. In some markets, we've seen a slight pullback in rates, whereas in others, we've exceeded projections. Ultimately, it's hard to tell if we've been affected by the slowdown in Airbnb due to its increased supply. The reason for that is it's hard to decipher if the slowdown was due to seasonality because we just went through winter. Was it the tailwinds of the pandemic, the slowdown in stimulus as a result of the pandemic, the announcement of layoffs and higher borrowing costs? We've had a lot happen recently, and we don't believe it's accurate to cast a blanket statement that there's a global Airbnb bust. As I mentioned before, real estate is hyper-local. There is no doubt that the major destination areas have experienced a dramatic drop in demand, such as the Phoenixes, Orlando, mountain towns, beach communities, etc. We believe that the reason is simply oversaturation in those areas. This is because when you think of buying a vacation rental, you think of the beach and national parks. So when everyone was sitting at home during COVID, they saw an ad online or a news article about the next Airbnb millionaire. Everyone went out and bought in the most predictable locations, many based on travel trends, mainly due from COVID. This is the exact reason why we buy in boring towns in middle America, next to hospitals, nationally recognized universities, and institutions. We are willing to sacrifice the sex appeal of the desirable locations and potential for appreciation for limited competition and predictable cash flow. The STR space is very fragmented. What I mean by that is there's only a very few amount of professional operators. The typical operator can't withstand many slow months until they throw in the towel, and we are already seeing it. They purchase properties at inflated values on inflated revenue projections with no plan B and are now focused to sell their properties at a loss. Moreover, STRs are not a passive investment like everyone was led to believe. It is incredibly time intensive, especially if you do not have the scales or systems. I think many people were way in over their heads and are just now realizing it. We believe over the course of the next few years, we will see only the strong operators survive who provide real value to guests through professional levels of hospitality, services, and amenities. Behind us are the days when you could slap together a room with IKEA furniture, take your listing photos on an iPhone 6, and fill up your calendars. For us, the timing of the Airbnb bust articles and the real estate market crashing articles could not be better. We haven't seen so many opportunities available since we've been active in this space. Right now, in our opinion, is the perfect buying opportunity. While others are exiting and telling everyone how terrible it went for them, we are building inventory and filling in for that lost supply. Abbott, you mentioned you underwrite your LTRs at a 0.9% rule. Please explain. Correct. So the 0.9% rule is simply a measure of the monthly rent the property can generate relative to its value. For example, if the property value is $100,000, we would need a monthly rent of at least $900 to proceed. This is a quick rule of thumb designed to inform us if the property will cash flow, as it gives us a buffer to cover all the typical operational expenses and debt payments. That so far is it for questions. I know we're definitely pushing to the end of the limits from a time perspective, so I think we'll wrap up here. I want to thank everyone for your time and for sticking around, for those that have. And if you have any questions, please feel free to reach out to us. We'd be happy to chat and provide any further information that you require. And I hope everyone has a great evening. So thank you. Bye for now.